The variance analysis cycle begins with the preparation of performance reports in the accounting department. Reports highlight variances, which are differences between actual results and what should have occurred according to the budget. The significant variances are investigated to discover their root causes. Next, period's operations are carried out, and the cycle begins again with the preparation of a new performance report for the current period. Actions are taken to improve performance. Learning Objective 1 is to prepare a planning budget and a flexible budget and understand how they differ from one another. A planning budget is prepared before the period begins and is valid for only the planned level of activity. If the actual level of activity differs from what was planned, it would be misleading to evaluate performance by comparing actual costs to the static, unchanged planning budget. A flexible budget provides estimates of what revenues and costs should be for any level of activity within a specified range. When used for performance evaluation purposes, actual costs are compared to what the costs should have been for the actual level of activity during the period. This enables apples-to-apples cost comparisons. Larry's Lawn Service provides lawn care in a planned community where all lawns are approximately the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. Since all of the lawns are similar in size, Larry felt that the number of lawns mowed in a month would be the best way to measure overall activity for his business. Larry identified 7 major expenses for his business. In addition, Larry estimated a cost formula for revenue and for each expense in terms of the number of lawns mowed. Revenue, along with each of the 7 major expense categories and their relationship to the number of lawns, Q, is as follows. Revenue, $75 per lawn, Q. Wages and salaries, $5,000 plus $30 per lawn, Q. Gasoline and supplies, $9 Q. Equipment maintenance, $3 Q. Some expenses are not directly related to the number of lawns mowed. They are the fixed costs. Office and shop utilities, $1,000, office and shop rent, $2,000, equipment depreciation, $2,500, and insurance, $1,000. Larry's static planning budget is based on an activity level of 500 lawns. Assume that Larry's actual results for the month of June are as shown. Notice that Larry actually mowed 550 lawns. If Larry wanted to, he could compare his actual results to the planning budget as shown on the slide. Notice that a variance is computed for revenue and each expense item. The planning budget column and actual results column have apple and orange icons to emphasize that the amount in both columns are based on different levels of activity, 500 versus 550 lawns. Revenue variances are labeled favorable when actual revenues exceed budgeted revenues, and they are labeled unfavorable when actual revenues are less than budgeted revenues. Expense variances are labeled favorable when actual expenses are less than budgeted expenses, and they are labeled unfavorable when actual expenses exceed budgeted expenses. Has Larry done a poor job controlling those costs with unfavorable variances? Has he done a good job controlling the costs with favorable variances? The answer is unclear because the actual activity level, 550 lawns, does not equal the planned activity level, 500 lawns. This raises an additional question, namely, how much of the cost variances are due to higher activity and how much are due to cost control. To answer this question, we must flex the budget. Flexing a budget involves 2 key assumptions about cost behavior. First, total variable costs change in direct proportion to changes in activity, and second, total fixed costs remain unchanged within a specified activity range. Let's continue the Larry's Lawn Service example by preparing a flexible budget at the actual level of activity. Larry's flexible budget for an activity level of 550 lawns mowed is as shown on this slide. The key to preparing a flexible budget is to state each variable cost as a function of activity. For example, gasoline and supplies are equal to $9 per lawn, and the variable portion of wages and salaries is $30 per lawn. While variable costs are expressed per unit of activity, fixed costs are not. The fixed costs are not sensitive to changes in the activity level. Notice the Q in all revenue and cost formulas is 550 lawns mowed. So, for example, revenue of $41,250 is computed by multiplying $75 times 550. Wages and salaries of $21,500 is computed by multiplying $30 times 550 plus $5,000 in fixed salaries. Can you compute the flexible budget amount for wages and salaries at a different level of activity? The question on the following screen will ask you to do that. Here's the question. What should be the total wages and salaries cost in a flexible budget for 600 lawns? Total wages and salaries is the sum of the $5,000 of fixed portion plus the $18,000 of variable portion. The variable portion is computed by multiplying $30 per lawn times 600 lawns. Learning Objective 2 is to calculate and interpret revenue and spending variances. A revenue variance is the difference between what the total revenue should have been given the actual level of activity for the period and the actual total revenue. A spending variance is the difference between how much a cost should have been given the actual level of activity and the actual amount of the cost. We have seen the impact that a change in activity has on revenues, costs, and profits, but we haven't yet answered the question, how well did Larry control his revenues, costs, and profits? We will answer that question by computing revenue and spending variances. Revenue and spending variances for Larry's lawn service would be computed as shown on this slide. Notice, it should be noted that the actual results and flexible budget columns are both based on 550 lawns mowed. The $1,750 favorable revenue variance indicates that actual revenue exceeded the budgeted amount that would be expected for an activity level of 550 lawns mowed. This could happen for a number of reasons, including an increase in the amount charged for each lawn or a change in lawn services. In Larry's case, several homeowners requested some additional edging and trimming beyond the customary monthly services that resulted in increased revenue. The $1,950 unfavorable spending variance indicates that total expenses were $1,950 greater than would be expected for an activity level of 550 lawns mowed. Larry explained the individual spending variances that make up the total $1,950 unfavorable spending variance as follows. The $2,000 unfavorable wages and salaries spending variance occurred because of extra hours required for the additional trimming. The $150 unfavorable gasoline and supplies spending variance was primarily the result of rising gasoline prices. The $350 favorable equipment maintenance spending variance occurred because maintenance was postponed in order to get the extra edging and trimming work completed. Fixed cost variances are not the result of increased activity. The utility bill was less because the weather was milder than normal for June, while insurance was higher because of an unexpected premium increase. Overall, net operating income was $200 less than would be expected for an activity level of 550 lawns mowed. Learning Objective 3 is to prepare a flexible budget with more than one cost driver. It's unlikely that all variable costs within a company are driven by a single factor, such as the number of units produced or labor hours. More than one cost driver may be needed to adequately explain all of the costs in an organization. The cost formulas used to prepare a flexible budget can be adjusted to recognize multiple cost drivers. Because of the large unfavorable wages and salaries spending variance, Larry decided to add an additional cost driver for wages and salaries. The variance is due primarily to the number of hours required for the additional edging and trimming. So Larry estimates the additional hours and builds those hours into both his revenue and expense budget formulas. The new revenue formula is $75 times the number of lawns, Q, plus $30 per hour spent on edging and trimming, H. The new cost formula for wages and salaries is $5,000 plus $29 per lawn, Q, plus $25 per hour spent edging and trimming, H. As you can see, the flexible budget is based on mowing 550 lawns with 100 hours spent edging and trimming. The new flexible budget, based on both the number of lawns and the additional hours for edging and trimming, is used exactly like the original flexible budget that was based on number of lawns. The new flexible budget should result in more accurate budgets and variances. A standard is a benchmark or norm for measuring performance. In managerial accounting, two types of standards are commonly used by manufacturing, service, food, and not-for-profit organizations. 1. Quantity standards specify how much of an input should be used to make a product or provide a service. For example, A. Auto service centers like Firestone and Sears set labor time standards for the completion of work tasks. B. Fast food outlets such as McDonald's have exacting standards for the quantity of meat going into a sandwich. 2. Price standards specify how much should be paid for each unit of the input. For example, A. Hospitals have standard costs for food, laundry, and other items. B. Home construction companies have standard labor costs that they apply to subcontractors, such as framers, roofers, and electricians. C. Manufacturing companies often have highly developed standard costing systems that establish quantity and price standards for each separate product's material, labor, and overhead inputs. These standards are listed on a standard cost card. The standard price per unit for direct materials should reflect the final delivered cost of the materials net of any discounts taken. The standard quantity per unit for direct materials should reflect the amount of material required for each unit of finished product, as well as an allowance for unavoidable waste, spoilage, and other normal inefficiencies. A bill of materials is a list that shows the quantity of each type of material in a unit of finished product. The standard rate per hour for direct labor includes not only wages earned, but also fringe benefits and other labor costs. Many companies prepare a single rate for all employees within a department that reflects the mix of wage rates earned. The standard hours per unit reflects the labor hours required to complete one unit of product. Standards can be determined by using available references that estimate the time needed to perform a given task or by relying on time and motion studies. The price standard for variable manufacturing overhead comes from the variable portion of the predetermined overhead rate. The quantity standard for variable manufacturing overhead is expressed in either direct labor hours or machine hours, depending on which is used as the allocation base in the predetermined overhead rate. The standard cost card is a detailed listing of the standard amounts of direct materials, direct labor, and variable overhead inputs that should go into a unit of product, multiplied by the standard price or rate that has been set for each input. Standard costs per unit for direct materials, direct labor, and variable manufacturing overhead can be used to compute activity and spending variances as described in the previous chapter. Spending variances become more useful by breaking them down into quantity and price variances. This is our focus in this chapter. Differences between standard prices and actual prices, and standard quantities and actual quantities, are called variances. The act of computing and interpreting variances is called variance analysis. A quantity variance is the difference between how much of an input was actually used and how much should have been used, and is stated in dollar terms using the standard price of the input. A price variance is the difference between the actual price of an input and its standard price, multiplied by the actual amount of the input purchased. Quantity and price standards are determined separately for two reasons. 1. Different managers are usually responsible for buying and for using inputs. For example, the purchasing manager is responsible for raw material purchase prices, and the production manager is responsible for the quantity of raw material used. 2. The buying and using activities occur at different points in time. For example, raw material purchases may be held in inventory for a period of time before being used in production. Quantity and price variances can be computed for all three variable cost elements: direct materials, direct labor, and variable manufacturing overhead, even though the variances have different names as shown. Although quantity and price variances are known by different names, they are computed exactly the same way, as shown on this slide, for direct materials, direct labor, and variable manufacturing overhead. The actual quantity represents the actual amount of direct materials, direct labor, and variable manufacturing overhead used. The standard quantity represents the standard quantity allowed for the actual output of the period. The actual price represents the actual amount paid for the input used. The standard price represents the amount that should have been paid for the input used. Learning Objective 4 is to compute the direct materials quantity and price variances and explain their significance. Here's an example that will give us an opportunity to compute materials quantity and price variances. The materials quantity variance, defined as the difference between the quantity of materials used in production and the quantity that should have been used according to the standard, is $50 unfavorable. The quantity variance is labeled unfavorable because the actual quantity exceeds the standard quantity allowed by 10 kilograms. The materials price variance, defined as the difference between what is paid for a quantity of materials and what should have been paid according to the standard, is $21 favorable. The price variance is labeled favorable because the actual price was less than the standard price by 10 cents per kilogram. The standard quantity of 200 kilograms is computed by multiplying the standard quantity per parka times the number of parkas made. The actual price of $4.90 per kilogram is computed by dividing the actual cost of the material by the actual number of kilograms purchased. The equations that we have been using thus far can be factored as shown and used to compute price and quantity variances. The purchasing manager and production manager are usually held responsible for the materials price variance and materials quantity variance, respectively. The standard price is used to compute the quantity variance so that the production manager is not held responsible for the performance of the purchasing manager. The materials variances are not always entirely controllable by one person or department. For example, the production manager may schedule production in such a way that it requires express delivery of raw materials, resulting in an unfavorable materials price variance. The purchasing manager may purchase lower quality raw materials, resulting in an unfavorable materials quantity variance for the production manager. In this example, the company produces a zippy. The direct materials standard calls for 1.5 pounds per zippy at $4 per pound. Last week, Hansen purchased and used 1,700 pounds of materials to produce 1,000 zippies. The 1,700 pounds of materials cost a total of $6,630. Now, we will see several questions based on the information on this screen. You may wish to take some notes to use as you answer the questions. Try to answer each question before advancing to the solution. How many pounds of material should Hansen have used to make 1,000 zippies? Hansen should have used 1,500 pounds, the standard quantity for 1,000 zippies. What is Hansen's materials quantity variance for the week? The standard quantity is the amount of materials that Hansen should have used to make 1,000 zippies. We find the standard quantity by multiplying the 1.5 pounds per unit standard for one zippy times the 1,000 zippies. Now that we know the standard quantity, let's calculate the materials quantity variance. We find the materials quantity variance by multiplying the standard price for 1 pound of material times the difference between the actual quantity of materials and the standard quantity of materials. The $800 unfavorable materials quantity variance results because Hansen used 200 pounds more than standard to make the 1,000 zippies, and each pound of material has a standard price of $4. What is Hansen's materials price variance for the week? We find the materials price variance by multiplying the actual quantity of materials purchased times the difference between the actual price per pound and the standard price per pound. We find the actual price per pound by dividing the $6,630 total actual price paid for the materials by the 1,700 pounds purchased. The $170 favorable materials price variance results because Hansen paid 10 cents per pound less than standard for 1,700 pounds of materials. Here we see a summary of the materials price and quantity variance computations in a convenient 3-column format. You may find this 3-column format more helpful than the equations that we used to answer the previous 3 questions. Recall that the standard quantity for 1,000 zippies is 1,000 times 1.5 pounds per zippy equals 1,500 pounds. Learning Objective 5 is to compute the direct labor efficiency and rate variances and explain their significance. Now, let's turn our attention back to Glacier Peak Outfitters to illustrate the computation of labor rate and efficiency variances. The labor efficiency variance, defined as the difference between the actual quantity of labor hours and the quantity allowed according to the standard, is $1,000 unfavorable. The efficiency variance is labeled unfavorable because the actual quantity of hours exceeds the standard quantity allowed by 100 hours. The labor rate variance, defined as the difference between the actual average hourly wage paid and the standard hourly wage, is $1,250 unfavorable. The rate variance is labeled unfavorable because the actual average wage rate was more than the standard wage rate by 50 cents per hour. The standard quantity of 2,400 hours is computed by multiplying the standard hours for one parka times the number of parkas made. The actual price, or rate, of $10.50 per hour is computed by dividing the actual total cost for labor by the actual number of hours worked. Factored equations can also be used to compute the rate and efficiency variances. Labor variances are partially controllable by employees within the production department. For example, production managers, supervisors can influence the deployment of highly skilled workers and less skilled workers on tasks consistent with their skill levels, the level of employee motivation within the department, the quality of production supervision, the quality of the training provided to the employees. However, labor variances are not entirely controllable by one person or department. For example, the maintenance department may do a poor job of maintaining production equipment. This may increase the processing time required per unit, thereby causing an unfavorable labor efficiency variance. The purchasing manager may purchase lower quality raw materials, resulting in an unfavorable labor efficiency variance for the production manager. Let's return to the Hansen Company and compute labor variances. The direct labor standard to produce each zippy is 1.5 hours at $12 per hour. Last week it took 1,550 direct labor hours to produce 1,000 zippies, and the total labor cost was $18,910. Next, we will see several questions based on the information on this screen. Again, you may wish to take some notes to use as you answer the questions. Also, just as you did with the material variance questions, try to answer each question before advancing to the solution. What is Hansen's labor rate variance for the week? We find the actual labor rate by dividing the $18,910 total labor cost by $1,550 direct labor hours actually worked. Now that we know the actual labor rate, let's calculate the labor rate variance. We find the labor rate variance by multiplying the actual labor hours worked times the difference between the actual rate per labor hour and the standard rate per labor hour. The $310 unfavorable labor rate variance results because Hansen paid 20 cents per labor hour more than standard for 1,550 labor hours actually worked. What is Hansen's labor efficiency variance for the week? The total standard hours for labor is the amount of time Hansen's employees should have worked to make 1,000 zippies. We find the total standard hours by multiplying the 1.5 standard hours for one zippy times the 1,000 zippies made. Now that we know the total standard hours, let's calculate the labor efficiency variance. We find the labor efficiency variance by multiplying the standard rate for 1 hour of labor times the difference between the actual hours of labor and the standard hours of labor. The $600 unfavorable labor efficiency variance results because Hansen's employees worked 50 hours more than standard to make 1,000 zippies, and each hour of labor has a standard rate of $12. Here we see a summary of the labor rate and efficiency variance computations in a convenient 3-column format. You may find this 3-column format more helpful than the equations that we used to answer the previous 2 questions. Learning Objective 6 is to compute the variable manufacturing overhead efficiency and rate variances and explain their significance. Now that we have studied material and labor variances, let's take a look at variable manufacturing overhead variances. We will return to Glacier Peak Outfitters to illustrate the computation of variable manufacturing overhead, efficiency, and rate variances. The variable overhead efficiency variance, defined as the difference between the actual activity of a period and the standard activity allowed, multiplied by the variable part of the predetermined overhead rate, is $400 unfavorable. The efficiency variance is labeled unfavorable because the actual quantity of the activity, hours, exceeds the standard quantity of the activity allowed by 100 hours. The variable overhead rate variance, defined as the difference between the actual variable overhead costs incurred during the period and the standard cost that should have been incurred based on the actual activity of the period, is $500 unfavorable. The rate variance is labeled unfavorable because the actual variable overhead rate was more than the standard variable overhead rate by 20 cents per hour. The standard quantity of 2,400 hours is computed by multiplying the standard hours for one parka times the number of parkas made. The actual price of $4.20 per hour is computed by dividing the actual total cost for variable manufacturing overhead by the actual number of hours worked. Factored equations can be used to compute the rate and efficiency variances. Now let's return to the Hansen Company and compute the variable manufacturing overhead variances. The variable manufacturing overhead standard to produce each zippy is 1.5 hours at $3 per hour. Last week it took 1,550 hours to produce 1,000 zippies, and the total variable manufacturing overhead cost was $5,115. Next, we will see several questions based on the information on this screen. Again, you may wish to take some notes to use as you answer the questions. Also, just as you did with the material and labor variance questions, try to answer each question before advancing to the solution. What is Hansen's rate variance for variable manufacturing overhead for the week? We find the actual variable manufacturing overhead rate by dividing the $5,115 total variable manufacturing overhead cost by $1,550 direct labor hours actually worked. Now that we know the actual variable manufacturing overhead rate, let's calculate the variable manufacturing overhead rate variance. We find the variable manufacturing overhead rate variance by multiplying the actual hours worked times the difference between the actual variable manufacturing overhead rate per hour and the standard variable manufacturing overhead rate per hour. The $465 unfavorable variance manufacturing overhead rate variance results because Hansen's actual variable manufacturing overhead rate per labor hour is 30 cents per hour more than the standard variable manufacturing overhead rate per hour for the 1,550 hours actually worked. What is Hansen's efficiency variance for variable manufacturing overhead for the week? The total standard hours is the amount of time Hansen's employees should have worked to make 1,000 zippies. We find the total standard hours by multiplying the 1.5 standard hours for one zippy times the 1,000 zippies made. Now that we know the total standard hours, let's calculate the variable manufacturing overhead efficiency variance. We find the variable manufacturing overhead efficiency variance by multiplying the standard rate for variable manufacturing overhead times the difference between the actual hours of labor and standard hours of labor. The $150 unfavorable variable manufacturing overhead efficiency variance results because Hansen's employees worked 50 hours more than standard to make 1,000 zippies at a standard variable manufacturing overhead rate of $3 per hour. Just as we did with labor and material variances, we can summarize the variable manufacturing overhead variance computations in a convenient 3-column format. You may find this 3-column format more helpful than the equations that we used to answer the previous 2 questions. When the quantity of materials purchased differs from the quantity used in production, the quantity variance is based on the quantity used in production and the price variance is based on the quantity purchased. Here's an example that will give us an opportunity to compute materials quantity and price variances. The materials quantity variance, defined as the difference between the quantity of materials used in production and the quantity that should have been used according to the standard, is $0. There is no quantity variance because the actual quantity equals the standard quantity allowed. The materials price variance, defined as the difference between what is paid for a quantity of materials and what should have been paid according to the standard, is $21 favorable. The price variance is labeled favorable because the actual price was less than the standard price by 10 cents per kilogram. End of Chapter 9.